To analyze the structural mechanics of the current market, we are running the raw data through the KNM AI Bot, an enterprise-grade algorithmic engine designed to map institutional order flow. This dashboard highlights the surface metrics driving current retail panic. On the left, retail sentiment is pegged at an extreme fear rating of 8 out of 100, coinciding with a 14.2% drop in the Bitcoin network hash rate. However, the right side of the dashboard shows $76.6 billion in USDT stablecoin volume sitting idle on exchanges. While retail sentiment remains at historic lows, specific altcoin sectors are beginning to capture aggressive, sustained bids. This discrepancy suggests that while retail is exiting on dead momentum, a massive volume of capital is remaining parked on-chain rather than off-ramping into fiat. The data indicates we are neither in a traditional bear cycle nor an active bull phase, but rather a suppressed volatility accumulation regime. This environment is particularly dangerous for traders using high leverage. The market functions like a coiled spring, vibrating within a narrow range and whipping back and forth to liquidate both late shorts and early longs. To navigate this compression, we must map the true liquidity zones. We will use the KNM multi-factor regime engine to decompose the order flow and identify the underlying structural support. In this phase, navigating the market requires traders to detach from retail sentiment and execute strictly based on mathematical structure. This weighting matrix is the framework the KNM AI uses to separate noise from signal. The first two inputs loaded into the model are lagging indicators, a neutral trend and weak momentum. We then add the third bearish factor, the declining hash rate. These three factors combined typically trigger false capitulation signals for retail trend followers, who often perceive these lagging metrics as a confirmed breakdown. However, the fourth slot introduces a heavy override factor, stable liquidity. The $76.6 billion in idle capital mathematically outweighs the preceding bearish signals. The final slot tracks extreme sentiment. The algorithm reads peak fear as a contrarian indicator, marking zones where institutional bidders step in to absorb retail panic. By weighting institutional liquidity and sentiment overrides against lagging trend data, the AI generates a more accurate representation of structural intent. When the five factors are synthesized, the matrix resolves into a single output, the accumulation phase. The model identifies this as a structural compression. The algorithm is prioritizing high-conviction liquidity signals over the immediate volatility of the price action. This chart maps the Bitcoin price structure at the $68,000 equilibrium against the 50-day simple moving average and the VWAP. The price currently hovering near the VWAP and the SMA 50 indicates active institutional mean reversion, where algorithms pin the asset to its historical averages. Looking lower, we can identify immediate liquidity pools at $64,000 and $65,000. Below those levels sits the deep panic flush zone, resting between $61,000 and $62,000. Above the current price, we find the upper stop hunt clusters between $70,000 and $71,000, where short sellers are currently trapped. The macro trend only shifts upon crossing the breakout threshold, which forms a ceiling at $73,000. Within this range, retail fear is driving up implied volatility, making derivatives positions increasingly expensive to maintain. High implied volatility, combined with trapped open interest on both sides of the price, makes directional breakout bets highly inefficient. This creates a range trap. Bots actively sweep the mapped liquidity pools in both directions, harvesting premium without establishing a definitive trend. The order book is currently weaponized against standard retail breakout strategies, necessitating a pivot in execution. This network map tracks the flow of funds beyond Bitcoin, identifying where capital is rotating within the broader ecosystem. We are seeing a measurable exit of liquidity from older Layer 1 networks and classic DeFi protocols. That capital is routing into specific inflow vectors, with the gaming sector currently showing a positive 3.37% performance metric. Additional inflows are concentrated in the AI sector, up 0.59%, and Layer 2 infrastructure. These capital movements indicate that institutional players are positioning for the narratives of the next cycle, while retail attention remains fixed on the sideways action in Bitcoin. Further confirmation comes from Ethereum's relative strength, as it outperforms Bitcoin by 0.93% on the ratio. Institutional allocators often use Ethereum's strength as a risk-on signal. This behavior points to a quiet accumulation of beta rather than a broad retail rally. This targeted rotation suggests that while Bitcoin remains stagnant, capital is being actively repositioned into the assets likely to lead the next volatility expansion. Based on the synthesized data, the AI generates a forward modeling scenario tree. We can discount the tail risks. The data does not currently support an immediate euphoric breakout or a total structural capitulation. The engine assigns a 65% probability to the central path. This path begins with a liquidity sweep down to the $64,000 zone, designed to trigger the fear trap and clear out remaining retail longs. This is followed by rapid institutional absorption at those local lows. After the downside liquidity is cleared, the model projects an aggressive bounce back through the $70,000 threshold. Executing based on this sequence, the liquidity sweep followed by the absorption, allows a trader to enter at the point of maximum retail pain, where the risk-to-reward ratio is mathematically skewed in their favor. Translating these macro projections into micro execution requires a shift in tactical focus. Directional leverage bets and breakout strategies are high risk in this regime. The grid indicates a red X for these traditional retail approaches. The objective is to adopt a delta-neutral mindset that remains profitable during periods of extended market chop. This regime favors gamma scalping and straddle option strategies, which allow a trader to capture and profit from erratic volatility spikes in both directions. For spot positions, the data favors selective accumulation during extreme dips, specifically within high relative strength sectors like AI and gaming. We maintain a strict rule against shorting fundamentally strong Layer 1 assets, even if they appear weak on shorter timeframes. The market is currently compressing energy. While this creates significant opportunity, the current regime rewards mathematical precision and punishes decisions driven by retail fear.